चहा बनतोय का?
Good evening, everyone. We're honored to welcome all the dignitaries, industry professionals, and our dear students to the Pan India webinar, Finance Fundamentals for Millennials, organized by the BMS, BFM, and BBI department of Lala Lajpat Rai College, Mahalakshmi, Mumbai, in association with the Board of Industry Academia Partnerships. We thank all the participants for such an overwhelming response. We received registrations even from Tier 2 and Tier 3 cities. We have with us this evening CMA Sarvotam Rege, Coordinator, BFM, ML Dahanukar College, as a distinguished panelist. Dr. Neelam Arora, Principal, Lala Lajpat Rai College, Mahalakshmi. Dr. Arun Pujari, Vice Principal, Lala Lajpat Rai College, Mahalakshmi. Let us begin our session on an auspicious note with the Saraswati Vandana, offering our respect and seeking guidance from the goddess of knowledge.
या कुन्देन्दुतुषारहारधवला या शुभ्रवस्त्रावृता या वीणावरदण्डमण्डितकरा या श्वेतपद्मासना या ब्रह्माच्युतशङ्करप्रभृतिभिः देवैः सदा वन्दिता सा मां पातु सरस्वती भगवती निःशेषजाड्यापहा.
Thanks. I now request Parth to give an opening note.
Thank you so much, Ashna. Good evening, ladies and gentlemen. My name is Parth Shukla. I am from the Board of Industry Academia Partnerships, and I welcome you all and I thank you all for being here today with us. Now, we at BIAP are concerned with enhancing the collective potential of students. We aim to bridge the gap between industry and academia, igniting minds and awakening hearts. That's our vision and mission. The primary objective of every session is to echo its vision statement. We have a team of experienced learners, trainers, facilitators, academicians, etc., who have catered to varied learner groups right from school children, college students, school college faculty, army officers, police officers, doctors, lawyers, self-help groups, Gram Panchayat, senior citizen associations, and many more. In its short tenure, BIAP has conducted a number of investor awareness programs and various customized training programs and having impacted the lives of more than 3 lakh individuals across the country. We aim at doing so during these challenging times as well, which is why we have come up with an initiative of webinar management where BIAP, along with colleges like Dhanukkar, Lala, etc., continue to educate individuals through live seminars on important topics like education post-COVID-19 and many more. These seminars are available on our YouTube channel as well. Our YouTube channel goes by the name BIAP Official. And so I request you all that if you want to go through more knowledgeable content, do visit our social media handles as well. I now request Ashna to take over. Thank you.
Thanks, Parth. I now request Dr. Arun Pujari, Vice Principal, Lala Lajpat Rai College, Mahalakshmi, to deliver the welcome address and formally announce the beginning of this session.
Well, thank you, Ashna. Good evening to all. On behalf of Lala Lajpat Rai College, I welcome all the student participants, faculties, and our guest speaker of the day, Mr. Sarvattam Rege. I am overwhelmed with such a massive response from the students. Over 1800 students have enrolled this webinar, and definitely credit goes to Lala Lajpat Rai College, BMS, BBI, BFN, and BIAP, which is Board of Industry and Academia Partnership. BIAP is a professionally driven certified trainer company which conducts certification program in many colleges of Mumbai, including Lala Lajpat Rai College. When the idea of having a webinar together stuck few days back on the area of finance, which resulted in the massive response. Let me not speak much, but one thing, though we all are down with lockdown, but still can use this time as an opportunity and learn as much as possible. In this regard, college has hosted many webinars and one such today along with BIAP on the topic Finance Fundamentals for Millennials. Today's resource person, Mr. Rege, has rich experience and expertise in the field of finance, and I'm sure he will do justice to the topic. Hope all the students will have lots of learning at the end of the day. Thank you. Thank you so much.
Thank you, sir. I now request Dr. Vedehi Kamath to introduce our esteemed panelist for this webinar, Mr. Sarvottam Rege, CMA.
Thank you, Ashna. Hello, all. It's my privilege and honor to introduce Professor Sarvottam Rege, sir. He is a certified management accountant, USA, as well as a fellow member of the Institute of Cost Accountant of India, FCMA, and completed his master's in commerce with management specialization. He has done his basic graduation in commerce, BCom, from KC College in Mumbai. He is also a member of IOD, Institute of Directors. Sir has 22 years of work experience in finance and costing department at senior level with leading corporates in India like L&T, Celetron India, Fiat India, Mahindra and Mahindra, Glenmark Pharmaceuticals, Parley Agro, Zydus Nycomed, and Classic Stripes. In addition, he has handled cost and management accounting assignments for Hindustan Unilever Limited, Johnson and Johnson, Rallies India, Bayer India, Pfizer India, etc. Mr. Rege also has 10 years of teaching experience with leading undergraduate colleges in Mumbai. He is also a visiting faculty for CMA USA in and associated with PTVA's Institute of Management for MMS. Besides industry and teaching assignments, he is continuously guiding the budding entrepreneurs on financial and business decisions. Regeser's objective in life is to contribute towards making the present education system industry oriented by introducing corporate realities and dynamics in the classroom and create investment awareness in the young generation. Sir, we are certainly fortunate to have you with us for this webinar. We thank you for accepting our invitation and gracing this occasion. Thank you. Over to Ashna, please.
Thanks a lot, Vedehi ma'am. This Pan India webinar has been specially organized to strengthen your fundamentals in finance. Now, I would request our esteemed panelists to take it from here on.
Thank you, Ashna. Uh, Good evening, everyone. It's a pleasure to be over here with you all. And the number that Sir quoted, 1800, and I'm really tense whether I'll be able to match up to the expectation of the group or no. It's I would like to take you back to my college days. I did my graduation from KC College Churchgate in the year 1993. And in my TY BCom exams, I had Lala Lajpat Rai College as my center. So almost after 25, 26 years, I'm getting associated back with Lala College for this particular webinar. It's an honor for me. Thank you, sir. So let me share the presentation with you. Before that, let me assure you that we are not here to discuss the impact of COVID-19 on various industries. We are not here to discuss how Indian economy is going to shape up. We are not here to discuss because of COVID, whether the students are going to get job, what happens to examination, no. So for next 1 hour, we will not be discussing anything related to COVID-19. For a change, we will not discuss anything with respect to COVID-19. Maybe we will have some small references here and there with respect to COVID, but other than that, there will not be any major discussion on coronavirus as such. So let me share my file with you. Okay, finance fundamentals for millennials. Now, who are millennials? The term millennial generally refers to the generation of people born between early 80s and 90s, according to Merriam-Webster dictionary. Now, you all are millennials, you know, like born in the 80s and 90s. And I would like, had it been a one-to-one face-to-face session, probably we would have interacted on this particular question. But then I'm asking the question to you and I'm answering on your behalf. What do you all expect from your life? Why are you studying? What you want to do in future? What are your career goals? What's your mission? What's your vision? What's your objective in future? All these questions are asked to you by your parents, by your teachers, by the consultants with whom you interact. But let me tell you, more often than not, people from your generation or other students from your generation will have the expectation like high salary, visit all the places in India, going for a world tour, eat good food, drink good stuff, buy expensive branded clothes, accessories, cell phones, buy a luxurious bike, cars, stay in big houses, and if possible, save something for the future. This is what majority of the younger generation thinks like. You know, like when I was young, when I was a student, we used to think like, let's earn some good salary and let's save 50% of the salary and manage the show in balance 50%, and then let's invest in particular type of investments, and let's see how those investments are going to grow, and let's see where it takes us from there. But your generation has as they say in economics, you know, propensity to spend rather than propensity to save. So let me draw you all to a point wherein let us agree that we need high salary. Why are you taking this education? Sir, we want to learn something new. We want to learn something which will upgrade our knowledge. We want knowledge more than money. So those of you who feel that knowledge is important, money is important, yes, I agree to that point. But then if I tell you that I have a company and I'm offering you a job, and in that company I'm going to give you a job which will give you the highest level of job satisfaction. You will have fantastic place to sit. I'll give you Apple laptop, Apple phone. You will have free food, and I'll give you car. I'll give you everything. The job profile will be fantastic, but I'll not pay you salary. Will you join my company? The answer will be obviously no, sir. I will not join your company, because eventually salary that matters the most. Because with salary I'm going to pay my EMI for my house. With salary I'm going to pay for my medicines. With my salary I'm going to pay for my day-to-day expenses, my luxuries, my world tours, my food, my car, my branded clothing, my cell phones. I need money for paying for all these expenses. And so you are telling us that you will give us the satisfaction and not the money. No, we are not interested in joining your company. So eventually job satisfaction is important once you go in industry, but along with job satisfaction, money, the salary, the remuneration is equally important for you, because for running the show you need money. Your houses are not going to get run on the basis of job satisfaction, for which you need money. So how to earn money? I'm not going to tell you today what is accountancy and what is cost accounting, what is management accounting, what is financial management, how accounting is different from what you learn in your textbooks, and how it is going to be different in the industry. Industry expectations are completely different. No, I'm not going to talk about that. I'm going to teach you a way through which there is a likely chance that you may earn high money, more money, legitimate money, legal money. Okay, so with this, let me take you to the next slide. How to fulfill these expectations? We need money, lot of money. So what are the traditional investment options that you have? Assume that you have completed your graduation and you have joined a company. You finished your chartered accountancy or cost accountancy, or you've done your MBA, and you are about to join, or rather you have joined a company wherein say your salary is around lakh of rupees per month. Traditional days, going back to early 90s and 80s, when I was a student and I started earning my money, the options available for me were these, you know, fixed deposits, public provident fund, national savings certificate, post office savings, life insurance policy, real estate, and last but not the least, gold investment in gold. So these are the traditional investment options which are available to you today. It was there when I was a student. It's going to be there, say, 100 years down the line. These options will always be there as the safest traditional investment options. Let's move ahead. Out of which, okay, let me just explain for those who are not aware of what these options. Fixed deposit is a deposit with bank or with corporate entity, wherein you get fixed rate of return by way of interest, and this interest is taxable. Public provident fund is a fund that is created with government of India, and wherein you have to invest. When I started my PPF account, that time it was 60,000 rupees a month was the maximum possible investment. Nowadays it is 1.5 lakh rupees, and you get interest something in the range of 7.5% on that. National savings certificate is again government backed investment, wherein if you have to invest money and within 6 years you will get additional interest or the incremental interest on that investment. Post office savings are similar to the bank savings, wherein you can save your money, you can open fixed deposits with post office. Life insurance company, we all are aware, or life insurance policy, wherein you insure your life, and if God forbid something happens to you, then the amount or the proceeds are paid to your family. Real estate is investment in house, flat, a land, or any other immovable property. And gold is gold. So let's come to public provident fund and national savings certificate. Let me tell you a story. I graduated from KC College in the year 1993, and when I was in second year, I was told by one of my friends that let's open PPF account. Okay, so I went to bank, Central Bank of India at Opera House, and there we opened a account, public provident fund account. And the person who was interacting with me from bank, he showed me one calculation wherein he told me that if you invest 60,000 rupees per year, remember in the year 1992-93, 60,000 rupees was a huge amount. Okay, in 60,000 people used to buy 1 BHK flats back in 90s. So 60,000 rupees was a huge amount. So with 60,000 rupees a year, in next 25 years of investment, if you invest 60,000 rupees every year, after 25 years, you will get a sum which is close to a 1 crore rupee. So within 1 year, you will be a crorepati man. So we were like, wow, 25 years, invest 60,000 and get crores of rupees. Similar was the case with national savings certificate. National savings certificate means within 5 years or within 6 years, if I recollect correctly, your money used to get doubled. So you invest 10,000 rupees today. After 6 years, you get 20,000 rupees flat. Okay, so those were the heroes of 90s. Whenever you have extra money, put it in PPF or put it in national savings certificate, and within 6 years, 7 years, your money will get doubled. Rate of interest was 13%, 13% in 1993, and that rate came down to 7.1% in 2020. So reduction of almost 6% in the rate of interest. Returns from national savings certificate, that is NSC, are taxable now. Those days in 90s, these returns were not taxable. Nowadays, it is taxable. Okay, so this PPF and national savings certificate lost its charm. The way they had their own days in 90s. Now, if you ask people, do you invest in PPF? Do you invest in national savings certificate? Very few of them will say that yes, we do. And some of them, the younger generation, may not know what is PPF and what is NSC. Coming to gold, gold is one of the best investments that you may have. Excellent with as far as the safety of your investment is concerned, the safest return. But unfortunately, we Indians, for us, it's a dead investment. I would like to tell all the female members, especially the female students on this particular forum, that go back to your house, or you're in your house itself, and just talk to your mom and dad. Tell them that let's sell off the entire gold and invest in some other possible security, in some other investment wherein we will get better return. The moment you tell your parents that let's sell gold, you will get a tight slap on your face, because gold in India it's not supposed to be sold. It's the like the last resort. Whenever you feel that you don't have anything to eat, you have lost all your money. In that case, only Indians will touch gold. Otherwise, people will not sell gold at all. The point is, sir, gold is an excellent investment. Yes, very good investment. Is it the safest investment? Yes, it is the safest investment, but it is not liquid. If I need money, I'm not going to sell my gold. Then what's the point in having this particular type of investment? Moving ahead, I'll show you a comparison of return on investment. Return on investment, traditional versus something called as mutual fund. This is the concept that I'm going to introduce now. Those who are studying BFM, they already know what is mutual fund, or those people from other stream, those who are interested in financial markets, they also know what is mutual fund. So let's have a 20-year comparison between fixed deposits and real estate and mutual fund. Okay, let's begin with fixed deposit. Say, for example, if I would have had fixed deposit opened in the year 2000, okay, 20 years back with State Bank of India, if I would have invested 10,000 rupees back then in 2000, today in the year 2020, I would have got 67,275 rupees. The CAGR, that is compounded annual growth rate, comes to approximately 10%. And I'm talking about pre-tax. There is no tax deducted on this. If you deduct 20% tax, then this will go down further to 7 or 8%. So the CAGR that I would have earned if I would have invested 10,000 rupees back in 2000, that CAGR comes to 10% with respect to fixed deposit. I stay at Jogeshwari, one of the suburbs in Mumbai, and the value of my flat, I purchased it in the year 2000 and I paid 14 lakh rupees, 14 lakh rupees for that particular flat. The market value of this particular flat is 1 crore 20 lakh rupees today. The CAGR, compounded annual growth rate, is 11.34. Let's compare mutual fund. For the sake of convenience, for example, I have considered one mutual fund over here, HDFC Top 200 fund. If you would have invested 10,000 rupees in this particular fund in the year 2000, over a span of 20 years, that is today in 2020, your 10,000 rupees would have become 3,61,831, and you would have got CAGR, which is very close to 20%. Let me add a disclaimer over here that mutual fund investments are subject to market risk. You need to read the prospectus and scheme details before investing in that. Considering all the risk factors that we have encountered right from 2000 to 2020, still this mutual fund would have given you almost 20% CAGR. What difficulties we encountered right from 2000 till today? In 2004, Mr. Atal Bihari Vajpayee lost his government, or BJP lost the election, and that his government was toppled in parliament. On that particular day, Bombay Stock Exchange went down. The Sensex crashed by almost 1,500 points. Then in 2008, we had almost a recessionary trend in our economy, the subprime crisis. Then we had 1999 Kargil war. So we have seen through all these difficult times, yet this mutual fund would have given you double the return than the fixed deposit and the residential flat. For this comparison purpose, I have not considered life insurance and medical insurance over here, because according to me, if you ask me, life and medical insurance should not be seen as an opportunity to invest. You should look at life insurance and medical insurance with respect to safety and risk coverage point of view. Life insurance policy returns could be 3%, 4%, but then in case of the maturity or in case of the death, then what family gets, that amount is helpful for that family to run the day-to-day show. So life insurance and medical insurance, I'm not going to consider it as investment option. I'm going to call it as safety and security option, the risk covering option. We have seen comparison with fixed deposits, comparison of real estate, and comparison with mutual fund, and we can see that mutual fund is almost giving you double the returns as compared to fixed deposit or real estate. Now, the next point is beating the inflation. Okay, we all have studied economics right from our FIJC till FIBCom, and we all know what is inflation. I've given few examples over here. Vada pav, the most favored food item in Mumbai, it is 15 rupees now in 2020. But when I did my SSC way back in 1988, I cleared my 10th exam in 1988. That time it was 50 paisa. The same vada pav which I used to get at 50 paisa, nowadays you guys are paying 15 rupees for that, almost after 30 odd years. So what has changed now? It's the same vada pav, it's the same vada, it is the same pav, it's the same chutney, but then the inflation has created this problem for us. Okay, so 15 rupees was a big amount back in 1988. 15 rupees has no great value today in 2020, because we pay 15 rupees for buying vada pav. In 88 we used to pay 50 paisa for that. So what has happened over here? The face value of rupee has remained same, but the purchasing power of that money has gone down. Okay, so and this is mainly because of the inflation. Second example is in the year 1988 in Vile Parle, the suburbs in Mumbai, in 1 crore rupee you could buy the entire building. But now in 2020, you can hardly buy a 1 BHK flat, or probably even you cannot buy 1 BHK flat in 1 crore rupees in Vile Parle. 20 years from now, in the year 2040, in 1 crore rupee, maybe you will get a single room in Vile Parle. So this problem happens because of the inflation. So now my point is, as a millennial, you want to multiply your funds. As a millennial, you want to multiply your finances. So your multiplication of finance should be in such a way that you will beat the inflation. You want to have vada pav today, you want to have vada pav 20 years down the line, but the investment that you're going to make, is it going to generate the kind of returns that will beat the inflation and that will beat the time value of money? See, 1 rupee of today is not going to be 1 rupee 20 years down the line. The value of that 1 rupee will diminish. It will go down. The purchasing power will go down. So if I tell you today that, friends, I have got 1 crore rupee with me today as of now, you will say that, wow, sir is very rich. He has got 1 crore rupee with him. But 40 or 20 years down the line, if you ask me, sir, you still have 1 crore rupee? If I say that, yes, I still have 1 crore rupee, then you will say that, sir, you're not so rich, because 1 crore rupee has lost its charm, because in 1988, in 1 crore rupee, you could buy the entire building. But in 2020, you can buy a flat, but in 2040, you won't be able to buy even a single room in 1 crore rupee. So the 1 crore rupee that you're holding has got a great face value. It says that it is 1 crore rupees. Wow. But then when I look at its purchasing power, the purchasing power could be worth 10 or 20 lakh rupees, which is not sufficient, which will not be sufficient in 2040. So how do I multiply my investments so that I beat the inflation, I beat the time value of money? So for me to have 1 crore rupee intrinsic value in the year 2040, I need to have something like 10 crore rupees today. Then I can say that, okay, I'm safe for next 20 years. No problem. I can live my life without doing anything. So how to multiply my money? Okay, so that is what we are going to see. There is only one legal and legitimate way of multiplying your funds. Okay, illegally going by illegal means you can multiply your money, but then that's not recommended considering the strict law in our country. So if you want to multiply your money in legitimate manner, the only option is financial market. So let's move towards that. These are the risky investment options, or the options wherein you can, through which you can invest in financial markets. First is equity shares, and then mutual funds through direct investment or systematic investment plan, exchange traded funds, futures and options, commodity market, and cryptocurrency. Cryptocurrency, I'm not going to discuss anything because we are not yet sure whether it is legal in India or no. Some people, some school of thought, they say that cryptocurrency, the bitcoins are legal in India, but RBI has not yet given the permission. They are in the process of discussing it with finance ministry, and still the ping pong table tennis is going on between government and RBI, and there's no clear cut guidelines whether cryptocurrency is legal or illegal. So something which has got a gray shade, I will not discuss it in this forum. Equity shares, popularly known as shares. People ask you where you have invested. I've invested in shares, sir. Okay. Mutual funds. Mutual funds are meant to be, you need to invest in mutual fund. Those class of people will invest in mutual fund. Those who are not sure which company to invest in. They don't possess the great knowledge about the share market, and they don't know how the dynamics of share market works, and they want to play safe because equity shares, somebody have told them that equity shares are very risky and you will lose a lot of money and all that. So for them, mutual fund is a way wherein you hire the professional managers to manage your funds, wherein you can invest a lump sum amount directly, or where you can invest monthly installments through systematic investment plan. Next is exchange traded funds. These are part of mutual funds only, but these exchange traded funds are specifically related to a particular underlying asset. There are gold traded exchange traded funds, which will be traded based on the prices of gold. There is Nifty ETF, Nifty exchange traded fund, which will move up or down based on the movement in Nifty. Next is futures and options, popularly known as FNO. These are contracts wherein there are underlying assets. Those underlying assets could be shares, could be commodities, could be currency. Okay. Then there's commodity market in which you can trade in. And as we said, cryptocurrency, we will not discuss. So, sir, what is so new about it? I mean, we knew that, and especially the students of BFM will say, sir, ye sab to pata hai. We have studied this in our second year and third year of BFM. So why are you telling us the same thing again and again? I'm telling the same thing again and again to you, but I'm going to give you a different perspective, and I'm going to show you certain facts and figures through which what could have been done and what you can do going forward. Okay. So my introduction to stock market begins in the year 1992, when I was in second year BCom, 91, 92 rather, when I was in second year BCom, as I told you, in KC College, and I was surrounded by all Gujarati and Marwadi friends. And one friend of mine, she was telling me that there's one IPO, initial public offer, coming up for a company called Infosys. So the minimum investment is 10,000 rupees. So Sarvottam, why don't you apply for this share? 10,000 rupees to hai, you can invest in it, and then the share of this company will increase in multifold, and you will be a crorepati in very few years and whatnot. That particular age, we all are looking out for making money. We need to settle down in our life, earn a lot of money and all that stuff. I came home and I asked my dad that, dad, please give me 10,000 rupees. My dad told me, why do you want this 10,000 rupees? I said, I want to invest in Infosys. Okay, I want to apply for the IPO of Infosys. My dad asked me, what is Infosys? So I said, it is some company which is related to computers. Those days, Infosys and all these type of companies were known as computer wala companies. So I told my dad, it's a computer wala company. So my dad said, how much money you want? I said, dad, just 10,000 rupees. And next was cut. I got a nice slap on my face. My dad said my salary is 5,000 rupees. From where I'm going to give you 10,000? Don't bother about the share market and all that. Don't invest in these risky options. These are not meant for us. It is meant for business class people. We are poor. We belong to a middle class Maharashtrian family, a salaried family, and we don't invest in this. For us, we have PPF and NSC and LIC and stuff like that. Think about those investment only. This share market is not meant for us. I went back and told my friend that I'm sorry, I can't invest. My dad doesn't have money, and obviously in SYBCom having 10,000 rupees was impossible for me back then. So I did not invest in, or I did not apply for that IPO of Infosys. That friend of mine, she applied, and today she's staying in 13th Road Car in 3 BHK apartment. And today I'm staying in Jogeshwari East in 1 BHK flat. So that's the difference between taking the right decisions and taking the decisions at right time. So that particular time I missed the bus. If I would have invested 10,000 rupees in the year 92 93 in Infosys, today I would have had minimum 13 crore rupees investment. Probably I would have had my own college. Okay. My story about profit is also very much interesting. As when my profile was read, in that you must have heard that I worked in corporates for 22 years, and after working in corporates for 22 years, I felt that I should do something for the student fraternity, and I came into teaching field. And after coming into teaching field, okay, I started teaching in Dhanukar College. I had to, there was a huge difference between the corporate salary and the salary of the teacher. And last almost 10 years, I'm into teaching field without getting affected financially. Thanks to the share market, some good investments that I have done when I started earning my income in corporate world. I started making some good investments, due to which I got good returns on my investment. And today I'm in a position to take a risk of switching into a job which pays me almost half the salary that I would have earned in the corporate world. So if you invest professionally, if you invest based on the analysis, if you invest based on the study, then there is a less chance of losing the money. Please don't be under the impression that if you invest in share market, you will be a millionaire or you are going to earn crores of rupees. No, there are cases wherein people have lost very badly in the share market. So it's not a success formula that I'm telling you. It's a path on which you can evaluate and you can study and you can analyze, and then maybe you can invest and earn reasonable money. But it's not a short formula for success. Talking about losses, I lost heavily in share market in the year 2004. I told you that Mr. Vajpayee lost majority in the parliament and his government lost the election. On that particular day, I had invested in futures of Ashok Leyland, and till that point, I was doing quite well in futures and options, and I was earning reasonable money. On the day of election result, it was more or less certain that Mr. Vajpayee is going to be the next prime minister, and the share market will go up by 1,000 points or so, and my Ashok Leyland futures will give me at least 25-30% return in one day. I was working for Fiat India back then. On the day of election, I was working for Fiat India, and I was interacting some financial proposals with my director, and that meeting was prolonged and prolonged. Okay, and my brother was continuously calling me over my cell phone. The phone was vibrating in my pocket, but since I was busy in meeting with director, I couldn't take the call. And after 1.5 hours, when we finished the meeting, I came out and I spoke to my brother and I checked out my account with my broker. My broker told me that, Sarvottam, you lost almost 90,000 rupees in one day. 90,000 rupees in the year 2004 was a huge amount. Today also it's a huge amount, but in 2004, it was much bigger than what it is today. 90,000 rupees, I lost it in one day thanks to this features and options. So I have told you the success stories also, the failures also, the miss bus also. Let me show you some calculation or the magic of equity market investment. You can see the note, 10,000 invested in IPO of Infosys in the year 92-93 would have been approximately 13 crore rupees today. So along with that, we are going to see some other companies, and we are going to see the horizon of 20 years. First is Asian Paint. Asian Paint was 16 rupees in the year 2000. On 18th of March, this is 18th of March data. Today we are on 27, almost a 10-day old data. The Asian Paint share was trading at 15,001. The CAGR comes to 26%, and the absolute return is 9,382%. Eicher Motors was trading at 49 rupees in the year 2000. Today it is close to 13,000 rupees. The absolute return of 26,000 odd percent. Hindustan Unilever was 227. Today it is 2005. ICICI Bank was 14 rupees in 2000. Today it is 299. ITC was 16 rupees. Today it is 165. Infosys was 117. Today it is 664. So on and so forth. Let me show you MRF. MRF also has a story. In MRF, I invested at around 800 rupees per share. And one of my friend had told me that Rege, ye share to 30,000 pe jayega. This share went up to 80,000 rupees. Today it is at 50,000, 56,000 odd rupees because of the COVID crisis that we have. But then this share was trading 60,000 plus, 70,000 plus. One share value was 70,000 and the 52-week high was something like 79,000 rupees per share. Reliance Industries was 59 rupees in the year 2000. It is 1400 rupees now. Titan was 7 rupees in the year 2000 and today it is 817. It was 18th of March. Today it closed at something like 883 or something. So if you see all these 11,000% absolute return, 2,000, 26,000%, or the CAGR, if you see, it is in the range of 10% to 26%. See, 26% CAGR over the period of 20 years is a huge return on investment. It's a huge return on investment. Let me tell you, the kind of returns that these companies have given over past 20 years, I assure you that such return, none of the government-based investments can give you. No FD can give you this return. No PPF or no national savings certificate can give you this kind of a return. But sir, as you said, there's a risk also. Yes, there is a risk. All these prices have seen the risk of Vajpayee government not claiming the majority. It has seen Kargil war. It has seen subprime crisis. It has seen the Doklam crisis. It has seen surgical strike and air strikes in Pakistan. It has seen all the possible negative. It is seeing coronavirus as well. 18th March figures, 18th May figures. These are latest figures, as latest as 10 days back. It has seen coronavirus impact also. Still, you are getting the CAGR in the right from 9 to 10% till 26, 32%. So on an average, if you see, it comes to around 25, 30% CAGR over the period of 20 years. And read the name of these companies: Asian Paint, Eicher Motors, Hindustan Lever, MRF, Maruti, L&T, State Bank of India. These companies are not going to get closed down because of Corona. Yeah, there will be impact of coronavirus on these companies. Yes, these shares will go down. Today, let me assure you, the prices at which these shares are available in the market, these are throwaway prices. There's a sale going on in the market. Those who have money, or even if you have small amount, start investing in these good companies with the horizon of course, 3 to 5 years. If you want immediate returns, then this is not the place to invest. But then if you are willing to wait for 3 to 5 years, these companies can give you 20 to 25% returns. Moving ahead, there are certain do's and don'ts of stock market investment. First, uh, assess your risk profile. Okay, always remember that each individual, every individual has got risk profile. Somebody is high risk taker, somebody is moderate risk taker, and somebody is low risk taker. So assess yourself whether you are a high risk taker or a low risk taker. Depending on, you should spread over your investment between your equity market and other safer investments. Invest based on fundamentals of the company and have goal based investments. Like for example, my son is studying in 10th now. My son is studying in 10th now, or next 10 12 years he'll be flying to US for doing his masters. So after 10 to 12 years I need say 50 lakh of rupees. So I will start my SIP today with the expectation or with the goal based return that after 12 years I want 50 lakh rupees or 30 lakh rupees or 25 lakh rupees. I want to buy a car after 5 years, and then probably I will invest in a share of say Reliance with the horizon of 3 to 5 years. That share will give me a return. I'll use that return for buying a car. So always have goal in mind why you are investing. Investment should be done based on the fundamentals. fundamentals of the company. We all are from accounts and finance background. Most of us have studied accountancy right from FISA till TY. You should be able to read the annual report. Okay, don't go by what Rege sir says, don't go by what your equity market professor says, don't go by what Rakesh Junjunwala says on CNBC. Okay, hear them out, but then your investment should be based on your own individual analysis. You may consult experts, you may consult your friends, consultation is fine, but eventually decision should be based on your own fundamentals rather than somebody has told you this or some tip has been given to you. Be patient. Okay, today you invested say 1000 rupees in the share of Asian Paint. Don't get impatient and every day don't start checking your demat account that अरे कितना बढ़ गया share, कम हो गया, oh my god, 100 rupees down, oh my god, 500 rupees down, oh wow, 1000 rupees more. No, don't do that. Give yourself sufficient time, okay, to see the multiplying effect. The multiplication will not happen overnight. There's no magic in this, it's all logic. Okay, there's not at all magic. So invest in these shares, give yourself sufficient time, and then see the fruits of your investment. Be in touch with your investment, keep a review, keep a close watch on your investment, but not every day, every minute, every hour. Once in a week, once in 15 days, once in a month, depending on the volatility in the market, please review your investment. Don't be afraid to book your losses. Sir, I incurred loss in this particular share, but what I'll do is I'll hold it for next 20 years. No, probably you made a wrong choice of investment. So accept your mistake. There is nothing wrong in accepting the mistake. And that one mistake is not going to throw you out of the market. The sky is not going to fall on you. So if you feel that you have made a wrong choice, correct your mistake, book the loss, take out whatever you can, and reinvest in some better company. You can always do mistake, but then every time you should do new mistakes. Don't repeat your mistakes. Please, 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 my humble request to each and every participant over here is study the economic conditions, government policies, RBI announcements, the announcements that Ms. Nirmala Sitharaman did in last week about the 20 lakh crore. I'm not getting political over here, whether you agree with her views, whether you feel those investments are good or bad, but remember that those announcements have got great impact on share market. So it is highly essential for every commerce student, for that matter, every student, to be in touch with government policies and RBI announcements that those are happening during the year. And the moment any announcement happens, you need to have your demat account ready on your phone and see how those announcements are impacting your investments. Okay, if you feel that any announcement done by RBI has affected badly with respect to particular share, and if you have that share and that share has lost its cream and it's not going to go up in the near future, and if you feel that you can switch over from that share to some other share, please go ahead and do that. Don't fall in love with your shares, because you never know when those shares will stop loving you. Okay, because why are you investing in shares? For returns, you need ROI, you need CAGR, you need a lot of money. So unless you sell your shares, you're not going to get money in your hand. But at the same time, don't sell it just for the sake of it. If you have some reason for selling the share, please go ahead and do that. But don't sit over shares just because you're holding that share for last 20 years. Don't get emotionally attached to those shares. Array, this particular share was purchased by my dad 30 years back, and my dad had told me that even my grandfather had invested in this particular share, so it is a share which belongs to our family, so I'm not going to sell it. Please don't do that. If you feel that that share is giving you enough returns, if you feel that the steam is over as far as that particular company is concerned, and if you feel that it is right on your part to sell the share today, please go ahead and sell it. Don't consider these emotional factors. Okay. Don'ts. Never invest based on tips given by best friends and so-called financial experts. If my students from Dhanukar College are here, they would know this story, how I was fooled royally by one of my best friends. My friend, my school friend, right, the friend who was there with me since my senior KG, he used to work for one of the financial brokers, and he gave me I will not mention the name of the company. He gave me one share and he told me that, Sarvottam, buy this share, my guarantee that your amount will be double. That share was something like 230 or something. I started purchasing based on, yaar friend ne bola hai. I started purchasing those shares, that company ka share. I started investing uh, heavily in that particular company. I made some money initially on trading. Then that company announced a bonus, and then that company had a split of shares, and I ended up having something like 4,500 shares at rupees average price of 7 rupees. So that friend again called me that the price of the share is 7 rupee now, and you have around 4,000 share. This 7 will become 14 in no time. This 14 will become 28 in no time. So just hold and hold. Okay. So believing or trusting that friend, I was waiting and waiting and waiting and waiting. And today, if you see, that price of that particular share is 35 paisa, 0.35, and that share is not tradable now on national stock exchange. I called up my friend, यार तूने बताया नहीं. He's telling me, oh मैं भूल गया यार बताने को, तूने बेचा नहीं क्या? That friend of mine had sold that share when the share was around 8 rupee or so, and he earned 1 rupee profit per share. But he forgot to call me, and today the price of that particular share is 35 paisa. I lost my money. So never ever trust or invest based on the tips given by your best friend or the so-called financial experts. As I told you earlier, don't keep blind faith in any recommendations given by television experts. The television expert, last 2 months I've been tracking some of the business channels, and these business channels are literally bluffing people. I have seen somebody recommending a particular share, saying that in next 3 or 4 sessions, this particular share will touch 300 rupees. The share was currently at 250, and now that share is at 235. Now, when the question is asked to those same panelists about, you mentioned about 300 and today the share is 235, they said, no, there were some pressures from the FIIs inflow. There was no FII inflow, no DII inflow. They'll give you excuses which are not understood by common people like you and me. So if any recommendation is given by any business channel, yes, accept it, but then again, go back to your basics and study the fundamentals of that particular company. If you can read the technical charts, read it yourself, or if you can do the fundamental analysis, please go and do that. Don't put blind faith in anyone. Follow the logic of stop loss. Stop loss is highly essential. Okay, what is stop loss? Suppose if I purchase a particular company share today, say Ashok Leyland was around 44 rupees today. If I purchase it at 45 rupees with the expectation that in next 2 or 3 days the share will touch 50 rupees. Okay, but then along with that, I need to put a stop loss at 41 or 42 rupees also. That means if my judgment is wrong about Ashok Leyland, and instead of going from 44 to 60 or 44 to 50, if it comes down from 44 to 42, then I need to sell that share. Automatically, my broker will sell that share. Okay, so I will minimize my loss. So for minimizing the loss, you need to follow the stop loss. As I mentioned, don't fall in love with your investment. Don't get emotionally attached to your investments. Don't keep all the eggs in the same basket. Means what, sir? What will happen if you keep all the eggs in the same basket? If one egg is broken, then more or less all the eggs will get spoiled with that. Somebody has told you that automobile industry is going to go up like anything. It's going to enter the boom phase now. Just giving hypothetical example. This is not true. So what I did is, some expert, so-called expert, has told me invest in automobile industry. I purchased share of Maruti, I purchased share of Hero, Bajaj, Mahindra, Ashok Leyland. Every possible every possible automobile company is in my portfolio. And suddenly there is some bad news coming up with respect to automobile industry, and all the automobile shares will fall. So diversify your investment. Don't put the entire amount in automobile industry. Bifurcate your investment amount or your core surplus into various industries, so that if one industry is not doing well, then the other industry will support. If other industry is not doing well, some third industry will support. Don't keep all the eggs in the same basket also means that don't invest all your funds in equity market only. Then sir, what to do? Maybe if you have 100 rupees for available for investment, depending on your risk profile, you may decide how much percent you want to put it in equity and how much percent you want to put it in mutual fund, which is relatively safer option as compared to equity, and how much percentage you want to put in fixed deposits. So always balance out your investment in such a way that you have plan B ready. Always have your plan B ready. That's what I always tell my students. Okay, thank you. That's all from my end. If you have any questions, you can ask me.
Thank you so much, sir, for such an enlightening session. Sir, we have already started receiving a lot of questions in our chat box. May we begin with the question and answer round?
Yeah, sure.
Okay. I also request the others to post their question in the chat box. Thank you. So, sir, the first question is, what are the best possible safeguards or precautions against market risks?
Safeguards against market risk. Okay. Just to add humor, if I have to tell you, you should pray every day that market remains within the range. See, especially under the current scenario, the COVID scenario that we have. Pardon me, I am coming back to COVID topic. I told you I will not touch upon it, but I have to. Especially with respect to current scenario, what you can do is, suppose if you have 100 rupees available with you, don't invest the entire 100 at the same time. Maybe you can divide that 100 rupees into 4 slots, that is 25 rupees each, and take a gap of say 15 days, 20 days, and start investing in the equity market, depending on the direction in which the equity market is going. They all, some experts, they always say that you should buy when the market is low and you should sell when the market is high. Sounds very simple, but it is impossible to find out what is the low and what is the high. So when you invest, assess the risk that market is having. Okay. And as I told you, break your 100 rupees into 4 parts, and out of which one part of 25 rupees invest in mutual fund. So let the division be 75-25. Let 75 rupees be invested in share market, that too in a phased manner, not at the same time. And your balance 25, let it go to mutual fund or some kind of a ETF. Now there's one Nifty ETF, exchange traded fund. Nifty has got like Nifty exchange traded fund. In that you can invest money. Nifty was 12,500 before COVID. Now it is around 9,100, 9,200. Start investing in that Nifty ETF. Today, Nifty is around 9,000. Even if in 3 years it touches 12,500 once again, you're going to gain. Your gains will be something in the range of 12 to 15%, which is not bad. So invest in phased manner. Don't invest lump sum at a time. Yeah.
Thank you, sir. I'll go ahead with the next question. Sir, could you differentiate F&O and equity in a brief way?
Okay. Equity means it's a share. If you're an equity shareholder, you are the de facto owner of in that particular company. In futures and options, what happen is, for especially talking about future, you will have a lot of shares. Equity shares, you can even buy 1 share. But in futures and options, you have to buy a lot of shares, because 1 lot of, say, again, Ashok Leyland, 1 lot of Ashok Leyland may consist of 5,000 shares. So your minimum investment could be in the range of 5 to 10 lakh rupees when it comes to investing in futures and options. And these are contracts wherein 2 parties enter into a contract, wherein person can buy the future, sell the future, depending on the price movement. But it is more riskier because your investment is very high in futures and options. possibly I'll take one special session on what is FNO, but to tell you in brief, as a student, as a newcomer, my sincere request to you is don't go after futures and options. You may feel that you are studying your BFM, you are in third year of BFM and you understand the entire market. No, nobody understands the equity market thoroughly. So go with mutual fund, go with ETFs, go with equity shares, futures and options. Maybe when once you start earning a lot of money, you can play with it on a smaller level, but not at this age. Yeah, thank you.
Good evening, sir. I am
Good evening.
Gibran from BIAP, and I'd like to, first of all, I'd like to thank you for such an engaging and such an enriching session. I'll be helping Ashna out with the question. So, another question that we've been getting is, what do you feel, how are mutual funds for students in degree colleges? Like, what are the prospects for degree college students?
From academics point of view or from investment point of view?
Investment point of view, like.
Okay, from an investment point of view. See, let me tell you something over here. I mean, I'm not trying to be political or supporting any political party or any political movement over here. But see, with this COVID-19 happening, the entire world has lost its faith in China. Okay, Japan is moving out of China. Germany is planning to move out of China. Many countries will move out of China. India should, I mean, it's a lengthy answer. I'm just giving you the background. India should look at these exits from China as an opportunity. See, suppose these companies which are exiting from China, even if India gets, say, 20-25% of these companies to come and invest in India by way of foreign direct investments, okay, then the entire economy will get a boost. We have seen our Prime Minister, Mr. Modi, he has traveled almost 100 odd countries in last 6 years. Okay, asking those companies to come and invest in India. So, and after this COVID, even if we get, say, 20-25% of these companies who are exiting from China, they come to India and invest by way of FDIs, then the entire economy will get a boost. There will be a foreign inflow happening in our country. The companies in India will have disposable cash in their hand. They will expand their business. There will be employment, and the importance of financial market will go up drastically. And when the importance of financial market goes up drastically, the shares of these particular companies or mutual funds associated with these companies are bound to go up. So if you invest today during the worst ever time the world has ever seen after World War II, then if you start investing in bits and pieces in smaller amount by way of systematic investment plan, wherein even if you invest 500 rupees per month today, and if you give yourself a 10-year horizon, the returns will be fantastic. And you know, the good days are going to come back. You can't be sitting in a lockdown situation forever. Someday we are going to move out. Someday the wheel is going to start spinning once again. Someday the economy is going to go up. Even if this someday comes after 1 year, still your investment will give you returns of 15 to 20%. So you blindly you can invest if you have surplus cash, of course.
Thank you, sir. So there's another question. If some company is giving amazing returns right now, will it continue to give the same in the future?
Share market investments are subject to market risk. Please read the red herring prospectus before investing. There's no guarantee. There is no guarantee at all. Because I have seen companies which were doing so well 20 years back, they are not to be seen anywhere. And the companies which were very small, see, look at Titan. In the year 2000, Titan share was ₹7 only. Okay, and today it is 890, and it has seen a high of 1390 also. Because of coronavirus, it is at 890. Prior to that, it was in the range of 1300 to 1400 rupees. And we know Titan for what? Titan watches. 20 years back, Titan was known for Titan watches. Today, Titan is known for what? For Tanishq, for jewelry, gold. Okay, so they have diversified. So there is no guarantee as such. So that's the reason I told you that you should keep on reviewing your investments every now and then. And after some time, maybe after 5 years, if I feel that Titan is not doing so well, I may sell off Titan and get into some other company which is doing well at that point in time. So don't fall in love with your securities because there is no guarantee. Okay. So let me give this disclaimer. Whatever we have discussed, there is no guarantee associated with this. There's a risk associated with this. Now you have to decide what is your risk appetite. If you're willing to take risk, jump into it. If you want safest way, then stick to your fixed deposit and national savings certificate plan. But then the returns will not be sufficient to take care of the inflation. Because if you get 8% return in fixed deposit, out of which 20% tax is paid to the government, so the return that you get in your hand is around 5.5%, 6%, and the inflation is around 5.5%, 6%. So whatever return you're earning, that will be taken away by inflation. So what is the net in your pocket? Zero or maybe negative also. So your return on investment should be something in the range of 15% or so, through which even if you pay 20% tax and inflation of 5-6%, still you will have 3 to 4% net in your pocket. So you have to look at the investments from that point. Thank you.
Another question that we've been getting is, what, according to you, what would be the basic points that we need to consider before considering any investment, be it COVID or not? In general, what should be the points that we consider before making any investment?
See, first of all, you should ask yourself a question: why you are investing? Do you have any goals? Like, I want to go for a foreign tour. I have a daughter who will be getting married in 5 years. I want to buy a 3 BHK flat. I want to buy a Mercedes car. What's your goal in life? I want to send my son to US for higher education. So depending on the goal that you have to decide that, okay, after 5 years, I want this much amount. After 10 years, I want this. After 15 years, I want this. And back calculate your investments based on the priorities that you have. Then you should look at ROI. The ROI that you are going to get, by ROI, I mean return on investment. The return on investment that you are going to get should be more than the bank rate. Currently, the bank is paying or bank is charging around 7-8% rate of interest, 7%, 7.5%. The return that you will get from the safer investment, PPF, is paying you around 7.1% interest. So the return that you're going to earn from your financial market investment should be more than 7%. If I have to earn 5% return by putting it in the shares or mutual fund, then I'll put it in PPF itself, which is the safest investment in our country. So if I'm taking the risk, I should ensure that I get that risk premium as well. So the return should be more than the bank rate. So any return in the range of 10 to 15% minimum is good enough for the financial market investments. Thank you. Next, please.
Thank you, sir. Another question. During COVID-19, which would be your preferable sector to invest in?
If I would have been answering this question 2 months back, I would have told you invest in pharma sector. But now again, pharma sector has reached a level wherein it's not entirely safe to invest in pharma. So if you have got money now and if you want to invest it, then invest in Nifty exchange traded fund. As I told you, Nifty is around 9,000 today. Even if in 2-3 years it touches 12,500, you earn something like 12 to 15% return, which is good enough. So other than that, it is very difficult. I can tell you where you should not invest. Don't invest in automobile. Don't invest in real estate, construction. But pharmaceutical industry, it has reached to a stage wherein it will go up further, but then a lot of ground is already covered. Okay. So maybe try for a mutual fund which invests in pharma companies so that your risk is, reduced. You can invest in a mutual fund which is specifically investing in pharma companies, and you can invest in Nifty ETF. That is relatively safer option. I don't say these are 100% safe options, but these are relatively safer options. Yeah. Next, please.
And another question, which could also be a sort of a follow-up to that one, a comparative question. During this volatile period, do you feel like mutual funds should be preferred over equity, or what is your take on that?
It all depends on your risk appetite. Are you willing to take risk? then yes, go for equity. But then again, as I said, divide it into 75-25, and based on your risk appetite, if you are a moderate risk taker, then you may invest 75 rupees out of 100 in mutual fund and 25 in equity. If you're a high risk taker, then the equation could be reversed. Yeah, I think I
Okay, sir, and what, according to you, which sector should an individual begin his or her investment in?
see, start with mutual funds. I would say start with mutual funds, and it is highly essential, that you invest your own money in mutual fund. And when you start investing in share, okay, it is also it's not essential or mandatory, but then if you lose your own money, that loss will teach you a lot of things. When I lost 90,000 rupees in one day, it taught me a lesson of my life. Nowadays, I don't lose money in share market generally speaking. So yeah, you have to invest in mutual fund. To begin with, mutual fund with systematic investment option is the best way for a person to start his or her investment. That's the safest option. And once you feel you're comfortable with SIP in mutual funds, then slowly, steadily, you can start investing in blue chip companies, equity shares. Thank you.
Okay, thank you, sir. Okay, Gibran, yeah, go on.
Yeah, so I just wanted to ask you, how would you contrast this tentative financial crash with the one that we had in 2008? Like coming out of it, how would you contrast both of those?
See, the major difference is the 2008 crash was something that happened in US and UK, and the implications were seen in India, because all the FIIs were, the foreign institutional investors were withdrawing their money from our country, and that is how our economy was going down. This particular COVID crisis are worldwide. I mean, I can't see a single country which is not affected by COVID. Everybody is affected. So it's a, the international problem that we are facing at the moment. The problem of 2008 was mainly related to subprime crisis happened in US and UK, and the implications were seen on India. We were not directly into it. The impact was seen on us. Here, the impact of China US trade war, the COVID crisis worldwide is seen on India, plus the impact of COVID crisis in India is seen on India. So that's the major difference between the two. But honestly, in my life of 48 years, and what I heard from my parents and my brothers and all that, this is something which has never ever happened in the history of our country. This is worse than what happened during World War II. So let's see what happens, how it goes. I think I answered that. Yeah.
Okay, thank you, sir. So this brings us to the end of the question and answer round. We have Dr. Neelam Arora here with us today to address the students. So I now request Dr. Neelam Arora to take it forward from here.
Stress level, stress. Hello. Yes, sir. Can you
Yes,
hear
ma'am.
me?
Yes, I'm audible.
Okay.
I'm audible.
Okay. Good evening, everyone.
Good evening, ma'am.
And thank you, lecture. I joined in very late, but I am sure now the main criteria, and everybody wants to know how to make financial plans. So I am sure that the lecture would be very, very useful to
Yeah.
them. Regesh, sir, with your vast knowledge, you will impart and I think guide them correctly. Thank you very much.
Thank you.
And thank you to Preeti and all the
Thank
other
you.
staff members for organizing so many activities, keeping the students occupied, gainfully occupied, I would.
Yeah. This is
Thank you,
becoming
ma'am.
new normal nowadays, ma'am.
Thank you, Neelam, ma'am.
So this brings us to the end of this engrossing engrossing and informative session. I would like to express thanks to the BMS, BFM, and BBI department of Lala Lajpat Rai College, Mahalakshmi. We express our deepest gratitude to CMA Sarvottam Rege sir for the enriching and thought-provoking session. We offer keen appreciation towards the ever supportive management, respected Principal Dr. Neelam Arora and Vice Principal Dr. Arun Pujari for their relentless encouragement, and CA Preeti Parekh, Dr. Rajesh Mankani, Dr. Vedehi Kamath. We're also thankful for the overwhelming response and active participation from our participants. We certainly hope that this session has been productive for all of you and wish that the knowledge shared with you today helps you in the industry. The link for the feedback form will be shared on the WhatsApp groups. Kindly fill in the same and we will be mailing the e-certificates to you in a week's time. For more such insightful and valuable webinars, check out our YouTube channel, BIAP Official. Like, comment, subscribe, and press the bell button for latest updates. Our next webinar is on 29th May 2020 from 6 p.m. onwards on the topic Writing a Winning Resume by Maniben Nanavati Women's College and Ram Narayan Rua in association with the Board of Industry Academia Partnerships. For more details, contact us at reachus@biap.in. Thank you.
Thank you, sir.
Thank you, ma'am. Thank you, ma'am. Thank you,
Thank you, ma'am.
Viraj.
Thank you, Viraj.
Thank you, sir.
Thank